right, everybody, the next panel I'm really excited about. So did you guys know you don't need to sell your Bitcoin to tap into the wealth of your Bitcoin? That's where Bitcoin collateralized loans come in. It's a very, very great tool, I would say, if you use it responsibly, to not have to sell your Bitcoin, but also benefit from your Bitcoin. So, and we got the big players in the game to be part of this panel. And you also have the best moderator in Bitcoin history, myself. That's going to be moderating the panel. So I'm really excited for that. Anyways, first and foremost, Mauricio Di Bartolomeo, the co-founder and CSO of Melton. Give him a round of applause. A bigger round of applause. Oh, yeah. Next one, we got Max Kai, CEO of Debify. Come on, everybody. That was super lame. One more time. There we go. Jonathan Melton, head of lending of Unchained. Does everyone just not like Unchained? There we go. Yes. Clap. And we got Sean Bill in the house. Okay. Well, guys, I'm super excited to be, with the industry leaders of the Bitcoin collateralized loan space. And I want to start with Mauricio first, because I think this is something that a lot of people don't realize. They can, they can use their Bitcoin, but a lot of people don't realize that, right? They have this perception that the only way to use your Bitcoin is to sell your Bitcoin. You want to talk about that, Mauricio, because again, it's unknown for a lot of people.
Yeah, so, everybody here probably knows borrowing against your assets is as old as time. I spend a lot of time in the lending world, and, you only have to read a little bit of history to, confirm or validate the fact that loans are older than coined money. We had interest-bearing loans before we had coined money. And in the beginning, or not in the beginning, but most people today are used to using pretty much every asset in their portfolio as collateral to access funding without selling it. It's what perpetuates the wealth of so many people, what created the wealth of so many boomers around America. And you can do the same with Bitcoin. This wasn't possible, I would say, the first sort of commercially viable Bitcoin-backed loan operations started coming out in like the 2017, 2016 era. And a lot of those guys are right here. And we're still doing what we started doing back then, just now with much bigger numbers. And I would argue, and I had a whole presentation on this, I believe that Bitcoin is the world's best collateral to use for a loan. There are many reasons for that. But to keep it brief, you can use any of our platforms today to take a Bitcoin-backed loan and get the cash you need without selling your Bitcoin. It's still your Bitcoin. You get the cash you need to make your investments or to pay for your expenses. And like any other loan, when you pay the outstanding amount, you get the collateral back. And all that appreciation that occurred during the loan is still yours. And more importantly, when you're taking a loan against your Bitcoin, it's most often not a taxable event. So it's actually pretty efficient from a tax planning perspective. And you can do this today with Bitcoin. In fact, today with Bitcoin, you can get a loan much faster, I would argue, than with any other asset in your portfolio. So it is a great, I'm sure we'll go at it at depth, but it is a use case that is growing exponentially because it works and people find value in it.
Max, have you had a similar experience?
Well, I think Mauricio told everything, basically, all the stuff. So I would probably comment on his quote about Bitcoin. I really believe that Bitcoin is a super collateral. That's the best asset to borrow. And I think in general, Bitcoin-backed lending we're still, it's a very small industry within a very small industry. It's still getting there. It's still starting. There are more and more platforms popping up. And I think the next bear market, people don't like talking about, but it will show, again, there will be stronger and stronger and stronger participants coming out who will survive multiple bear markets. And it's just only beginning.
Jonathan, the Unchained perspective. Talk to me.
Sure. So Unchained has been lending against Bitcoin since 2017. We have a unique approach. It was actually our first product. When a lot of people think about Unchained, it's in the context of collaborative custody. We allow people to hold their Bitcoin long-term savings in a sovereign way by holding their own keys. And our founders actually developed that product as the most secure tool for lending collateral, because lending was our first product. So we have a unique model that allows our users to actually hold a key to the wallet where their Bitcoin sits for the duration of the loan, and they can verify that the collateral hasn't moved, and that it's exactly where they sent it, 1 month, 2 months, 9 months into the loan. I share, the really constructive views of I'm sure everybody up here, and believe that a lending market is healthy for any asset. Bitcoin's very exciting, but it's not just another asset. It's an amazing new asset, but it's an asset that doesn't have a well-developed credit market. And I think that's the evidence of that is sort of in the structures of loans relative to other lending products that we all use sort of every day: HELOCs, 30-year mortgages, credit cards. But that's a function of a few things. What the traditional markets think about Bitcoin as collateral relative to what everybody at this conference thinks about it. But the Bitcoin journey continues, not only in price, but of different funding partners and pools of capital that are really interested in what we've all been doing for a while here.
Sean, you're the chief investment officer at Blockstream. Where does Blockstream fit in all this?
So I come at it from a little bit different angle. So Blockstream, is infrastructure and technology service provider to the Bitcoin ecosystem. I'm also the co-founder and CIO at Bitcoin Standard Treasury Company, which is going to be a $5 billion treasury company going public in April. And basically where we're trying to use Bitcoin as an asset and trying to actually capture active management on the Bitcoin. But when I look at the three fellas here, I think these are the tip of the spear of where you're pushing Bitcoin into the lending markets, right? And lending fiat against the collateral. And I think that's kind of step one. So when I step back, I've been in the market since 1994. I started the Chicago Board of Trade, trading commodities when it was open outcry, and first U.S. pension fund to buy Bitcoin. I got that into the pension in 2021. Did a lot of lending against Bitcoin miners that needed capital in 2022 when they couldn't get it anywhere else. So when I step back, what I see here is what junk bonds looked like in 1978, 1984, before it was well understood. There was a mispricing. Bitcoin is not well understood. And so you have much wider spreads in the market for what you can get on your lending against Bitcoin than what you really should be capturing if you look at it on a risk-adjusted basis. So, if you look at a Bitcoin loan, you're probably looking at anywhere from, at the low end on institutional for big size, maybe 7%. At the lower end, for a small retail loan could be, 12, maybe in that zone. To me, the risk on that, I think actually Bitcoin is less risky than a treasury bond, and it should be trading inside the treasury curve. So that excess spread, in my mind, is a layup for any institutional investor. And I think that we're going to see a lot more flow into these markets from the institutional guys, because they're going to be looking at, the credit quality of the instrument that they're lending against, and they're going to realize, okay, I got 600 basis points of excess spread over my risk. So I think you guys are at the front of it. I think you guys are the ones that are kind of pioneering it. And I think eventually you're going to find these institutional investors are going to approach you looking to put capital into the market. The spreads will come down, and the market will get more efficient.
Fantastic. I'm curious. I want to know in the audience, how many of you guys have heard of Bitcoin collateralized loans? Not everybody. How many have used a Bitcoin collateralized loan? Not enough. I got a promo code, but I have to use it after. Anyway, so I was asked to moderate this last second, so I'm going off the cuff. Bear with me. I'm going to spice it up. Let's do that. Let's start with Max. Max, why should people use Devify versus Ledin and Unchained?
Oh, come on. So actually, out of three of us, Sean is obviously a liquidity provider, right? And out of three of us, Devify is a bit different because we don't lend out money by ourselves. We just provide infrastructure. So why people should use us? First of all, we are non-custodial, which means that you can hold your key to the collateral, fully transparent. You can verify through any blockchain explorer that collateral sits there. And secondly, I guess people can use us in markets where they cannot use on-chain and they cannot use Latin for whatever reason. Because again, we provide infrastructure. So for us, it's hard, but also very easy to scale in certain markets. Like we can find a liquidity provider, officially licensed liquidity provider in a market where Latin doesn't serve customers or where on-chain doesn't serve customers. He will be plug and play into our platform. In 2 weeks, he can provide liquidity using our services. So we kind of compete, but kind of do not compete because we're not the end lender. We just onboard multiple institutional lenders from all over the world, and they compete on our open market platform. That's it.
Jonathan, I'm looking at you. Same question.
Sure. So Unchained, like I said, our franchise, our really value proposition in the market is all around multi-sig technology. So we have a commercial lending product. We're not consumer lenders. Our minimum loan size is $150,000. And really, the reason that we focus on that market has really been over time. We appreciate that multi-sig it's not the fastest. We're not set up to service thousands of loans. Coordinating multiple key signings. It's really built for long-term security. So the clients that come to us, a lot of Bitcoiners, maybe 80% of your stack is for long-term savings, 20% is for services. A lot of that 80%, will end up in multi-sig, whether it's us or another solution. So we really try to focus on, higher dollar, longer term, clients. And a lot of those are business and investment use cases. So, we're focused on the U.S. market. We lend to family offices, miners, corporations, lots of similar use cases. But I think the clients that line up best with us are focused, as I mentioned, on a truly unique. Holding a key is really important. I think that allows us to put our borrowers closer to their collateral than any other solution because they can cryptographically verify that their Bitcoin is still where they sent it. And having Mauricio said, and Max as well, we've all got a lot of experience, and we've been through cycles where, concepts like rehypothecation have been, important to the market because through a lack of, risk management and discipline, other lenders who aren't with us anymore, made some bad mistakes and people got burned.
Mauricio, mi pana.
So I think, Latin, how Latin is a little bit different than both Devify and Unchained. And again, I think all three, frankly, are excellent choices. What you have here is a product of basically years and years of, in multiple cycles of basically people coming in, promising things and failing to deliver, right? And what's here today are people that we've been doing this for longer than anyone else in this industry. Like, there's very few people out there that have been lending for more than 6-7 years, that have been through COVID, that have been through FTX and Alameda, that have basically stood by their clients and never let them down and were able to process transactions. Many others failed because they were taking excessive risk. So one of the commonalities, I would say, like even though we all have different flavors of how we store the Bitcoin, it always stays on an address. It doesn't get lent out. It remains basically in custody at all times. So at Latin, we're a regulated business, so we do support consumer loans. We operate in about 90 countries, and you can take a loan at Latin as little as $500 up to millions and millions of dollars. We service some treasury companies too, public and private. So we have a much broader range of sort of coverage. Our loans are built for, obviously we optimize for security. Like I mentioned, we did we had the first proof of reserves program in the industry, and something that we continue to do today on a monthly basis. You get a proof of reserves at Latin. And really, for me, I'm from Venezuela, and I needed the product very badly when I was mining down there. And I believe that this product could really have an impact in that part of the world. But if you didn't make it easy, accessible, a low ticket price that people can interact with, then you would be pricing a lot of those people out. And again, there's depending on what you want to do, I think both are very safe options, or all of us are very safe options. But it really depends on what you're trying to optimize for. And again, it is great to have competition, especially good competition, because in the past, we had these people that were advertising these ridiculous rates and poisoning people's expectations and luring people away with too good to be true rates. And listen, we're not the only 3 groups doing this, okay? There are people out there that you can Google and you're gonna find loans for ridiculous rates, promising you ridiculous things. If it sounds too good to be true, it is. And all you have to do is look back in history. There were a lot of lenders in 2021 that looked great, had slick logos, were shaking everybody, like all the right hands, only to let people down. So either choose a lender that either has on-chain reserves or proof of reserves. That would be one of the things that I would highly, highly emphasize. The rest is more you're picking your flavor based on your preferences.
Sean, I got a question for you based on your background. Do you foresee a future where traditional finance starts coming into the industry, and would they be competing with native Bitcoin companies? Because I obviously, as a Bitcoiner, I'd want the native Bitcoin companies to win. Do you foresee that happening in the next 5 to 10 years?
Well, I mean, if you look at what's happened with the ETFs, right? You know, you had Bitwise and some of the folks that were very early, and then you had BlackRock show up. And then, you know, nobody wants to compete against BlackRock, right? I mean, BlackRock put $100 billion into that ETF. So yes, they will show up. But I would say that, you know, it's not, I think Bitcoin is tough, and this credit on Bitcoin is tough. And so, you know, if I'm stepping back and kind of looking at it from a 60,000 foot view, I'd say, you know, one of the fellows may end up being the PIMCO of Bitcoin credit, right? It's like PIMCO in 1971. You know, it's a first mover advantage. You're doing something very different. How you underwrite your credit, how you look at your origination, are all things that are going to, you know, separate you out. And I spun out from PIMCO as a hedge fund back in 2004. You know, I joined my partner was from PIMCO, and you know, those types of institutions are going to have a much harder time kind of getting into this space on credit than, say, the fellas that are already there. And if you guys can get the momentum and kind of get the first mover advantage, I think that's pretty hard for them to catch. I think ETFs, generic stuff, equities. If you think about equity, it's very generic, right? And it kind of is very simple relative to credit. Credit's a much different game. Each loan has to be underwritten individually. I'd say like the biggest competition for the fellas might become you know, something like a systematic oriented credit underwriter, like a Theorem or somebody like that coming into the space. But I would also say in credit, it's not a winner takes all, right? You have PIMCO, and if I'm doing a portfolio, I'm looking at a PIMCO, a WAMCO, a Loomis. They all have different characteristics, right? And I want to have a little bit of this one, I want to have a little bit of that one, a little bit of this one, you know. So in credit, it's very different than equity. I think that, you know, it definitely is not winner take all.
Which one's your favorite? Just kidding, you don't have to answer that. I got a favorite, but I can't say it because I am professional.
I was going to say, I've known Max the longest. I watched Jonathan's, I've seen some podcasts where I thought, oh, that was very, very sharp stuff. And I know Ledin, and I know you guys have been around a long time, and you've done a great job. So I think all three are fantastic. And
Great
I think
answer.
They're going to be
Great answer.
I think you're going to see the institutional allocators look at folks like that to handle that business for them.
So I got a question for you guys, and feel free to jump in, right? So the last bear market, right? You saw a lot of, you know, Bitcoin collateralized loan companies just blow the F up. No, I can't say that. Oh, all right, I'm not on a podcast. But you saw some branding and some marketing used. I had to hold myself back, and it was marketed. A lot of these companies were marketed all over the place. You saw them left and right. They gave a lot of trust to a lot of people, and they blew up. BlockFi was one of them. Celsius was one of them, and they hurt a lot of people by them blowing up. It looks, guys, again, I'm not a tea leaf reader or anything like that, but we are a bit off the top. You know, we hit the 70K region today. So is this time different? Like, what are you guys doing? Why did those companies blow up, and what are you guys preparing for a potential bear market? So start with Max, and then we'll go to Mauricio.
I think the main reason why they blew up was that they were rehypothecating funds, and there was no control, obviously. So, and that's the main difference between us and them. I think we don't do that. I mean, for us, it's technically impossible. Also, Unchained technically impossible. Latin has proof of reserves, their own rules. It's also impossible, basically. So I think that was the main reason for BlockFi and Celsius, Voyager. I can go on. Blew up because they basically took customer money and they YOLO'd it with some weird hedge funds out of the garage and something like that. So it was like, it was the main reason. And now we're shifting, and I think in generally our industry shifted to, no replication, proof of reserve of proof of on-chain, and obviously, not generating yield on top of Bitcoin, which is like retarded in my opinion. So it's just borrowing against that. That's it. Yeah,
Technical term?
Yeah, it's a technical term. I always say that.
I would agree with that.
So,
Yeah.
I would add, I completely agree. I think rehypothecation was one of the big culprits. I also think it's important to highlight that a lot of these signs that these companies were taking excessive risk were already there. And if you wanted to look, all you had to do was ask some hard questions. So none of the companies that went under had proof of reserves. That's like number one. Most of the companies that went under had their own token. They were playing all sorts of financial shenanigans. So that's point number two. Point number three is you're talking to 3 Bitcoin-only companies on stage. That means Bitcoin is the only type of collateral we accept. That makes our business...
Four.
4. Oh, sorry. So
5.
So, everybody here is Bitcoin only, right? And so most of these companies that went under, I would argue all of the companies that went under, had a merry-go-round of the next hottest token to blow up their assets under management. And a big part of lending is who's giving you the cash to fund those loans, okay? So Ledin, our book is north of $900 million. So when we go and borrow, we have to go to very large groups and pull hundreds of millions of dollars and put collateral that's uniform. And when I deal with a bank or when I deal with one of our lending partners, we're putting Bitcoin as collateral and we're getting dollars as collateral. It's very simple. But when you're using Dogecoin as collateral, no serious entity wants to accept that as collateral. And so you have to find other means of getting that money. That means you're shorting the perp. And so again, complexity of the model adds an insane amount of risk to any type of lending operation. So simplicity, not having the sort of even the option of playing financial shenanigans with your tokens. And what was the last one? Bitcoin. Well, yeah. I'll stop.
Jonathan?
What's different this time?
We saw these huge companies
Is it different this time?
raised a ton of money, right? They were trusted, they were doing this, they were doing that, and then they blew up, right? Sure. What is Unchained doing differently?
Yeah, I think that it all comes down to risk management, both on the part of companies. You mentioned a lot of these companies were, if you look at their books, they were not focused on Bitcoin. So I think Bitcoin-backed lending is the only model that has been proven to work over time. So, a company making, a multiple billion-dollar loan and saying it's mostly collateralized, that's not a Bitcoin over collateralized loan. That's a failure of risk management 101 from the start. And so that's sort of, professionalizing the industry, and those risks are not going to be underwritten by investors because they prove to be flawed. Mining finance is another one where, I think there's a greater appreciation now than last cycle that the most fungible liquid collateral is truly Bitcoin, and that, even if you can sort of kind of think of a mining rig as more tangible and something that you would actually want to lend against because it's comparable to equipment finance perhaps, you can charge a little bit more. In a downturn, it's even more volatile and it's less fungible, and the workout risk on that loan is bad. But I think on the other side of it, risk management for borrowers is really important. And that's, what are we doing at Unchained? We make it very possible for borrowers to answer 2 questions. Where is your Bitcoin and who holds your Bitcoin? It's on the blockchain. And that's really important. Rehypothecation is simply taking the Bitcoin and giving it to a third party. And in traditional finance, rehypothecation happens. But it just adds a layer of risk management and more questions to ask. And in any sort of risk situation, there's substantial value in having the number of questions be few and the answers be really simple. So we try to do that.
So another question for the lenders. Will institutions dominate Bitcoin lending, or will individuals remain the primary lenders? Max, start with you.
Will institutions be well, they are already. I mean, it's like, I can speak on behalf of HODL HODL as well, which is like micro lending where retail versus retail. It's not comparable to institutional lending and to institutional books. So institutions definitely, as a lenders, they will dominate. And I think as a borrowers, it will be also the biggest part.
I said that incorrectly. Borrowers. Who will dominate? Institutional borrowers or individual borrowers? Sorry, guys, I'm doing this off the cuff.
I think institutional definitely, fortunately or unfortunately, because we have this huge amount over the last 12 months of treasury companies. They have a lot of Bitcoin on their balance sheet. And I think that it's already hard for some of them going out of the market and raising more and more capital. And one of the tools that how they can raise more capital is go and borrow against their stack, which is obviously already happening and is going to happen even more and more and more. So I think definitely institutions. I think it's going to be like 70% versus 30% because like all the money is there.
Mauricio?
Yeah, I would agree. I think so. We service public and privately, publicly traded and private Bitcoin treasury companies, and they are very large tickets. Again, not every publicly listed treasury company can access the bond markets. It's a very important distinction. And by the way, the cost of capital in the public markets is not that far off where we are right now. So I'll give you an example. Michael Saylor's perpetual preferreds are paying 11%. That's Michael's cost of capital. And it's not a direct comparison in that he's not necessarily taking a Bitcoin-backed loan. He's sourcing capital to buy Bitcoin with it. In many ways, it is very similar. It is not identical. But Michael's paying 11% on his money. At sort of $2 million plus, you can get a better rate than that at Ledin. And so it's not that far off from where even the public companies are sourcing capital today. But to Max's point, I do also think that institutions are going to play a very big role in terms of the size and the sort of overall quantum volume of borrows or outstanding borrows. And the reason I say that is because at the very beginning, I think and I'll say this as a sort of a reflection, there was this idea that everybody was just going to understand what Bitcoin was, and it was great collateral, and the world was going to adopt it because they were going to get it. But more and more, I see a group of people that really do get it, that appeal to reason. And then there's another larger group in the retail world that really is looking for just like an escape from a horrible situation, and they're looking for like a 20x overnight. And to them, Bitcoin is too slow. It's not the escape ticket. However, if you're a company and you have wealth to protect, or if you're a successful person and you have wealth to protect, Bitcoin becomes incredibly compelling, right? And especially a Bitcoin-backed loan because of how great financing is. So I'll give you another example that businesses have. Businesses, most often, can offset the interest expense from their revenues, which makes borrowing a lot more effective from them from a cost of funding perspective. Also, I mean, at least I'll say this for Ledin, when you're a business and you borrow from Ledin, small or big, you have limited personal liability. So at Ledin, business loans are not guaranteed by you personally, right? And I think that's a huge benefit. If you speak to an American, I've spoken to people in the US that are frankly nervous of taking that next step with their business because they're afraid they might lose their home, right? So there are some really big benefits, and I do think businesses are going to be a big, big part of the borrows.
Jonathan.
Yeah, I mean, I think that, one, truism is that it's very difficult in 2026 for any individual to buy 700,000 Bitcoin or tens of thousands of Bitcoin. It's really challenging. Even though Bitcoin is this bottoms-up phenomenon, there are institutions that have a lot of Bitcoin, and I think to Mauricio's point, not everybody has been in the public markets for 30 years with a track record like MicroStrategy. Perpetual preferreds are fantastic if you can get them. I mean, the ability to just not pay back the capital as long as you can service the interest is really powerful. I think like flipping the question, really good answers from Max and Mauricio. But I think that on the supply side, I do think that for me, the most interesting thing, having spent 13 years at Morgan Stanley and built a Bitcoin collateralized lending business at a commercial bank in Silvergate from 20 to 23, is at Unchained, we talk with lots of different pools of capital, but the conversations we're having with not only funds, but banks right now are interesting and very encouraging, because I'm very confident that the allocation of U.S. institutional balance sheets to, kind of closing that gap between, to Sean's point of what's the right price for the risk, and like where is the market clearing. I think, banks in particular, commercial banks, have a very attractive cost of capital, but, just weren't allocating. And now, even though price is much lower today, you couldn't have a more different environment from institutional sponsorship, Morgan Stanley, announcing an ETF, lots of hiring and staffing up on Wall Street. Those decisions are not made lightly. And obviously the regulatory, backdrop is very different. And bankers are generally risk averse. So I don't think they're gonna come in droves. But I do think, and I'm sure we're all having, great conversations with folks that, look, I looked at it back then, but, the way you guys are doing it, the way you've survived, you've originated a certain amount, you don't have any losses, you have the right mousetrap, and the environment's right. Let's keep talking. So that's what, like, connecting Wall Street and fiat to Bitcoin is. I think there's a lot of work to do there.
Sean, all these gentlemen here agree, and I agree also, that Bitcoin is pristine collateral. What does that mean? Because I saw a lot of people raise their hands, and a lot of people didn't raise their hand. They didn't even know about Bitcoin collateralized loans. So when you hear the term Bitcoin is pristine collateral, what does that mean? Why is it important?
Yeah, so I mean, being a 24/7, 365 access, right, where if a loan falls below its margin point, you can immediately liquidate it, makes it unlike pretty much any other market. And so that's where, in my mind, it's pristine collateral. We do see that somewhat reflected in certain circumstances. So at BSTR, we try to think like an entrepreneur with institutional resources, and we're trying to institutionalize some of the market. And so we completed a bond issue for 575 million USD at a 1% interest rate. And to us, that makes a lot of sense. Now we have to over collateralize the bond. It's 3-to-1 on the Bitcoin relative. So we tie up $1.5 billion plus in collateral. But you can get these deals done really at 0, 1, and then it converts into common up 30, 40, right, %. So it's a really attractive opportunity set for us from our perspective. I do think that what's going to happen is the pension funds and the endowment funds and these folks are going to find the players like the folks over here, and that will be their source of capital, right? So we have different strategies. I mean, for us, we're going to the capital markets, and we have 68 investors, and we raised $5 billion. We could have raised more. We left over $1 billion on the table, but we wanted to be selective in who we chose as our investors.
I want to add something to the pristine collateral point, because I think there's two things that maybe don't come out as immediately obvious on the sort of how important and how much of a shift being able to use Bitcoin as collateral is. For me as a lender, I think the fact that I can use the same collateral, whether you're in Colombia, whether you're in Madrid, whether you're in Florida, that means that I can scale my underwriting, right? All I need, your credit worthiness at Leiden and everywhere, I think all of us here, is determined by the value of your Bitcoin and the value of your Bitcoin only. And that, loans today at banks are income-based loans, also backed by your homes and your assets. Bitcoin-backed loans are not like that. A Bitcoin-backed loan, credit worthiness and debt capacity is determined by your Bitcoin.
So no credit check.
No credit check.
The only thing that's required is what, Mauricio?
Yeah. Pass KYC at least for me, and then have Bitcoin. That's it.
So this is a pretty interesting point. So in my prior life, I ran a hedge fund. That hedge fund was Bloomberg Hedge Week Multi-Strat Credit Hedge Fund of the Year in 2023 and 2024 back to back, or 2022, 23. And one of the techniques that we used was data science and data analysis. So we would look at peer-to-peer loans where we'd have a data set of 1 million loans, 140 variables, look through there, and we'd run the machine learning and have it give us back what it thought was important credit. And I think this will be coming to your space soon. So in our case, what was important was, did somebody use a tab button or a mouse, right? The guy that had the mouse was a higher likelihood of default than the person that was using the tab button, right? The person that was using all caps when they spelled out Chicago had a higher default rate than the person that went capital C, lowercase, right? So there's going to be a lot of this technology that will come in that will automate. And I can tell you right now, I talk to hedge funds that they're circling, trying to figure it out. So that's going to come. And when that does come, it's going to give them much more confidence in the underwriting and the capabilities that they have, and it'll bring the spread back in. So I think it's very, very, very early days in this space. I think the fellas here are, they've been in it for quite a while, and it probably seems like a long time, but it's still very early. And I think, the space has a lot of room for growth, and it will get, much more efficient. And I think, like I said, maybe one of these guys becomes the PIMCO of credit. That would not surprise me.
So I saw half the hands in the room not go up when I asked if you guys knew what Bitcoin collateralized loans. So I do want to talk about use cases, right? I want to make this a little bit educational. So I'm going to start off with Mauricio. Mauricio, why would someone be in a situation where they take a Bitcoin collateralized loan?
I'll give you the example we did this in this event. I don't know if any of you guys took BitDriver rides, but BitDriver, Napoleon is a good friend of mine, and he wanted to expand his fleet. He lives on a Bitcoin standard. He charges in Bitcoin. He keeps his treasury in Bitcoin. He didn't want to sell it. He learned that he would be able to take a loan with Ledin. We can service his business here in El Salvador. So he came to me and he says, hey, I'm going to take a loan to buy a car. And I got super excited because I thought, I love the idea. I love what he does. And the fact that we can help him grow the business, I thought was fantastic. So he took a loan, got a new car in time for the conference. He was not getting, because he is self-employed, he was shut down from traditional financing here in El Salvador. So he was able to use his Bitcoin, take a loan, expand his fleet, and through that, that led to many other things. But for him, that was the use case, right? Like and listen, I'll say this, like Bitcoin-backed loans today are still higher priced than traditional sort of finance, especially in the US at a tier 1 bank, right? And most people that come to platforms like us are people that basically have exhausted all other lower cost options, right? But we provide a solution for you, a solution that's not based on your income. And maybe if you do have the income and you can get that sweet 3% loan from Bank of America, then get it, right? Like the money's getting debased at 10%. Like if you can get money at 3 based on your income, by all means, right? Like why pay 10? Why pay 11? But when the banks shut your door in the face, if you want to start your own business, if you're self-employed, if you work in a gig economy, you do not have that access. And that's where we come in.
I mean, the use case, one of the obvious use cases, borrowing against Bitcoin to buy more Bitcoin. I mean, well, like 25, I saw your statistics, I think like 25%, 30%, 40% people, especially if stable coins are involved. Usually it's for trading purposes, right? People are buying more because like stablecoin conversion to Bitcoin is like very easy. But also one of the common use cases, buying real estate or upgrading your real estate, and also business. I mean, commercial loans. I don't know, expanding miners, expanding business, because they generate revenue in Bitcoin. They don't want to sell it. Different use cases, but yeah, mostly if we go to the micro lending, it's mostly buying more Bitcoin or just day-to-day expenses. If we go to larger tickets, then it's like commercial loans for business or like some big purchases like real estate or something else.
Jonathan?
Yeah, I'd say it's, we kind of think of our clients in a few different buckets. One is sort of family investment entities, anything from a family office to a high net worth person who just conducts investment business out of an LLC, as people do. And outside of Bitcoin, miners have ongoing CapEx needs to kind of replenish their fleet and make sure they remain competitive. And then, operating businesses. And as Mauricio said, when you're not underwriting, a balance sheet or an income statement, it's just a collateral. Speed is of the essence. And I think that ultimately, like to flip it around on the supply side, I think that the characteristics of Bitcoin-backed loans and taking risk on the collateral versus risk on companies, I think there is a time in an economic cycle when that is going to be really attractive to big pools of capital. Private credit is a buzzword and lots of money has flowed into that. But to the extent that's, sort of 13, 14% lending to companies that need a lifeline, that's very levered to the economy. And if bad things happen, that's going to be a tough workout process. Whereas if you have a Bitcoin-backed loan, they're generally right now, they're still very short term, hopefully longer. The products I'm sure will evolve over time. But 1 year, very over collateralized loan that trades 24/7, it's a much different risk and attractive diversification for credit investors.
Sean, what do you think is the biggest lie told about Bitcoin lending?
That's a tricky one.
I'm coming off the dome, dude. So bear with me.
Yeah, I don't know. I haven't really heard a whole lot about that. I think
Misconception.
yeah. Well, I think the risk would be the biggest misconception, right? So, I think I don't think Unchained's ever had a loss on a loan, right? Now,
Yes.
If we talk to a typical institutional investor, they would probably have no idea that that's the case.
Hey, wait, you give me something to work with. I love this. Okay. So let's talk about this, Max, Mauricio, and Jonathan. The vast majority, at least talking to Mauricio, I know this, the vast majority of your customers, they're extremely responsible with the loans, are they not?
They are extremely responsible. And I think, I don't want to speak on behalf of everyone else, but I'm pretty sure none of the companies here has ever had a loan loss or a loan default because of a client didn't pay, because we have the Bitcoin, right? So we can liquidate the asset. But what I see at Ledden, even now, at the beginning, these products were very new. People didn't know how they work. They didn't know how fast they would need to top up. They wouldn't know how. Some of them had, they were still trying to figure out how to send more collateral to the loan, right? And over time, people have gone more used to the model. Our platforms have collectively gotten better at helping people protect them, because all of us make more money when the loans are open than when they're closed. So we do not want these loans to get closed, as our clients don't want these loans to get closed. So we spend a lot of time on education. We spend a lot of time in building tools. At Ledden, we have this thing called auto top up that tops up the loan for you, among other things. We try to make it as easy as possible. Again, we want to align our incentives to those of our clients, right? Like if they win, we win. And it shouldn't be the other way around. I shouldn't be banking on making 2% fees on liquidations. I think that's wrong.
Max, do you see the same thing on your end?
Can you repeat again?
What was the question?
So your clients take good care of their Bitcoin. Nobody wants to get borrowers.
Yeah,
don't
we don't see many liquidation even today. The price dropped, but the LTV ratio is very healthy. It's usually at least 50%. So it's double the over collateral. And we provide different options how to avoid liquidation. And because we're a peer-to-peer market, and because there's a multi-sig involved, the liquidation is actually not happening instantly. So we saw sometimes where liquidation happened, borrower goes online and talks to the lender and saying I was flying or I didn't send a transaction. Can we restart? And then lender sends us collateral. Let's restart. Borrower adds more collateral. Everyone is happy. They restarted the contract. Let's go.
And that's a big difference between the banking system and the organic Bitcoin lenders. I won't name any banks, but there are some here that I think would be very happy to collect your Bitcoin if you came below your margin rate. So the fact that you can get some reprieve from that, even if it's only 24 hours or 48 hours, is another big differentiator between the folks up here and say a traditional bank.
Well, ladies and gentlemen, please give a big round of applause to the lending giants of Bitcoin.